Mic check 1 2 1 2. Let's get it, family. Welcome to part 2. Make sure you watch part 1 first. So if we're using any vocabulary, you up on it. So here we go. This is draft 1 of part 2. So let's start with the definition. What is this? Buying put options. The formal definition. You may not understand this up front, but as you watch this video once over again, make sure that you get to do it. So then when we do the lesson and the quiz, you ready to get an A on it. Here we go. Buying a put option. And again, you don't have to understand the formal definition yet, but as you come to learn this much better, you'll be more privy to what's going on. So here we go. Buying a put option gives the buyer, you, the right, meaning the option in this case, right? Buying a put option gives the buyer the right to sell an underlying asset. Whenever you hear underlying asset, they mean what stock are we talking about? If you buy an Apple put, the underlying stock is Apple. If you buy a BNGO put, the underlying stock is BNGO. So whenever you hear underlying asset, they're talking about what stock. So let's start over. Buying a put option gives the buyer, meaning if you buy the put, you get the right to sell the underlying asset at a price stated in the option, which is the strike price, with the maximum loss being the premium paid for the option. So whatever you paid for the option, that's the most you can lose. So if you pay $100 for a put option, you buy a put, the most you can lose is $100 on this put option. So now let's go through it once over clean. Buying a put option gives the buyer the right to sell the underlying asset at a price stated in the option, with the maximum loss being the premium paid on the option. Remember, all options have the risk of running to zero. Now, I just want you to know the risk. And again, make sure that you are managing your options well. Now, let's get it going and let's get it. So here we go. Let's go to our PowerPoint here and let's present. So, buying options. What is a put option? A put option is the option to sell. So if you buy a put option, you are buying the option to sell. And that'll make sense as we go on. Why do people buy put options? It is how you make money as the stock price comes down. Most people know that you can make money when you buy a stock and it goes up, but they tend not to know that you can make money when the stock comes down. But when you buy a put, remember, buying a put is not the same thing as selling a put. I want to be absolutely clear on that. Buying a put is different from selling a put. We are specifically talking about buying a put option, right? However, put options, when you buy them, they lose money as the stock price rises. So how do you make money on a put? You make money as the stock price goes down when you buy a put, but you will lose money if that stock price goes up. All right, now, premium. What is a premium? A premium is the cost of the option. So when you go and you buy an option, that's called the premium, whatever you paid. If you notice that the ask price is $100, then this is the premium. So whatever you pay for the option, that's the premium. And remember, when we talked about it here, we talked about it, where was it? Right here. It says buying a put option gives the buyer the right to sell the underlying stock, right, at a price stated, the strike price, with the maximum loss being the premium. So you could lose what you paid, no more than that. Okay, so now we understand premium. This is whatever you pay. So let's keep it going. What does the premium get you? The option to sell someone 100 stocks by the expiration. This is what the premium gets you. But remember, this is if you exercise. We are not looking to exercise. Exercise means you actually want to use the option. We generally never exercise the options. We are just looking to buy a contract, the put option, and then sell this contract to somebody else, and then we take the money. That's what we're looking to do. Okay, now, the premium gets you the contract. Now, what does the underlying stock mean? Like we talked about before, this is the stock that the option is tied to. For example, if you were to buy a $30 put option on Robinhood, what is the underlying stock? It's Hood. Robinhood is the underlying stock. Now, when to buy put options? So after your research, remember, you got to research here. After your research leads you to believe a stock has a high chance of falling, this is when you want to buy a put option. When you thoroughly researched it, and you say, okay, it's coming down. Now, here are some examples. Terrible news from a company. Absolutely terrible news. For example, we know that Lucid Motors is delivering cars. Let's say that they're about to deliver cars at the time of this recording. Let's say that they're about to deliver cars, and hypothetically, every single car that people get into they break down after 100 miles of driving. Every single one of them. That's terrible news, family. What would that do? This would send the stock flying or crashing like a rock. So then we would buy puts, right? Because we want to make money on the way down. What else? After a huge spike in price. So if something shoots way up, almost just directly straight up, and it's holding a high momentum and you know it's going to come down, then this is an indicator, not definite, but an indicator that it'll come back down. And I'm sure you've seen this 100 times when you see a stock flying up and then you go to buy it, and they call that chasing, right? You go and you chase it and then it drops on you like a rock. But what you should have done, in many examples, again, do your research, is buy a put. But remember, again, make sure that you're doing your research. Also, ask everybody else on the Discord how should they handle this to get some insight. Now, it's also a hedge against your long positions. Let's say that you were invested into Apple and you think that Apple, and you want to invest into Apple until retirement, but in the short term, you think Apple will come down and you feel like you're going to lose all of your money as the stock comes down. What you can do is say, okay, I have 100 shares of Apple. You know what? I think it's going to drop down. So then you buy a put on Apple, and then as your shares drop in value, your put option, your contract that you bought, will be gaining in value. So then you could eventually just sell that, and now you'll have money on the way down, but you were still holding the long position as well, but you just made money on the way down too. So now let's keep it going. When can you exit a put option that you bought? You can exit it immediately. It is day trading. Now, some brokers restrict you in the amount of times you can day trade depending on how much money you have in your account. Generally about 25,000. You are restricted to about 3 trades a day on some brokers, right? But you can sell it at any time. You are not trapped. You can buy it this second and sell it the next second as quickly as you want. But you can do this from now all the way up until expiration. And we generally do not hold until expiration for reasons we'll talk about later. And we actually mentioned it in the previous video, call options. Okay, now let's keep it going. Here's an example of a put option done on a car, right? This is Ken Griffin from Citadel Securities, Citadel LLC. And let's imagine that Ken Griffin has this car right here, and it's just sitting in his garage, and it's worth $10,000. This is the worth. Ken Griffin, you know what? He makes a contract. He's going to sell a put. We are going to buy a put. He's trying to sell a put. So he writes up a contract, and it says you can sell the car to Ken for $9,000. Remember, this car is worth $10,000, but he's saying you can sell it to him for $9,000. At this very moment, his contract has no worth. It's no worth. So you know what? He adds a date. He adds a date on it. And he says, you can sell this car to me for $9,000, but only until October 15th. Only until then can you sell this car to me. So now this contract is starting to have some worth because there is some potential there. There's some potential. And what is the potential? What if this car drops in price? 8,000, 7,000, and then he has to buy it from you for the 9,000. So then there's a chance now that this contract could be worth something in the future because it has a date and it has a price. So now the contract has some value. But if this doesn't make sense yet, stay tuned. Now you come out of nowhere, right? This is you, an ape, right? AMC ape, let's go. Now, you see a contract. You don't even see who wrote it, but you see a contract. And you see that it says, this contract right here gives you the option to sell this car for $9,000 until 10/15. Until 10/15. However, you know that the car is worth $10,000. So guess what? Your contract isn't worth a thing at this very moment. But watch how it gains value. You pay $100 for this contract. And your contract again says you have the option to sell this car for $9,000 until October 15th. What are you hoping happens? You're hoping that the car crashes into oblivion. So then you have the option to still sell it for way more than it's worth, right? Now, let's keep it going. Let's say that the car drops in value. The car just straight up drops in value. Something happens to the car. And remember, this car used to be worth $10,000. Now it's upside down. And it's worth $8,000. Ah, family. Remember that contract that you had that you paid $100 for? That said you have the option to sell this car for $9,000 until October 15th? Guess what? The car's worth $8,000 now. But you have the right to sell it for $9,000. So someone has to buy it from you for $9,000. Okay, so now you see how you made money there. But what if it went even crazier than that, right? Or even, you know what? It's now worth $150. Because again, the car price went down, so now your option contract is worth more. Your option contract is worth more than it used to be. Why? Because more people want this contract now. You have a contract saying you can sell a car for $9,000 that's now worth $8,000. Many people are going to want that. So now your contract used to be 100, now it's worth 150 in this example. Let's say that the car is really crashed into oblivion, and now it used to be worth 10,000, it used to be worth 8,000, and now it dropped all the way to 1,000, family. What will happen to your contract? Your contract will be even more valuable than before, because now you have a contract that says you have the option to sell someone this car. They are obligated to buy this car from you because they signed that contract, and now they are forced to buy this car from you for 9,000, even though it's worth 1,000. But they signed the contract, so now you made money as this car price went lower and lower and lower. Okay, so now what I want to show you is a real example actually using a stock. So let's say we have BNGO right here. We have BNGO right here, and it is currently $5.11. We're going to click trade, and then, excuse me, we click trade, and then what happens here is you see this. You see trade options, and then you click trade options. If you don't see trade options, what I want you to do is go to the Discord and then click on options chat, the options chat. And what I want you to do is then go to apply for options. You have to apply for options. So there are videos and tutorials in the Discord for that. Okay, now you click trade options. And then next, you'll see this. And I'll zoom in so you can see it a little bit better. Okay, so at this point, notice we have BNGO, and we're looking to buy a put. Notice these right here. This is Robinhood's interface. I have them using this because it's easy. So you go to buy a put. Now, remember, not sell a put, not buy a call, buy put. Okay, so now I'm going to zoom out a little bit so you can see the entire page. And now I'm going to zoom in again so you can see what I want you to see specifically. Right here in the middle, as you remember from the call option video, you'll see this. The share price is in the middle, and it's $5.11. Now that we know that, notice there are all of these numbers on the left. There are numbers called break even, so on and so forth. Okay, now let's look into this a little further. Notice we have a green arrow and a red arrow in this diagram right here. Let's zoom in a little bit, and let's look at the green arrow. Let's observe. I want to make this a little bit larger so you can see it easily on your screen. Remember, we're on buy a put. Okay, so now that you can see this more easily, notice the share price is $5.11. The strike prices are over here, 6, 7, and 8. Look at the break evens and why this is green. So remember, we want the stock to fall down. We want the stock to fall down because we're buying a put. So what that means is this. If the stock is currently $5.11, we want it to drop in order for us to make money on this put. So in the green, all of these are in the money, meaning the stock price for this put is actually lower than the strike. These are the strikes, 6, 7, and 8. So you could buy a $6 strike right here. The break even, you would need this to fall to $5.07. And once you get past that, by expiration, then you'll be just totally in the green. By expiration, but you do not have to hold until expiration. You wouldn't even have to get anywhere near 507 if you were to sell this option before October 15th. But only if you held for that long, you would need it to go to 507 and past 507 to drop under 507 and 506 for you to be in the green. Now, that's represented by negative 78%, a negative 78% or 0.78%, so less than 1% of a fall, right? But now, all of these are in the money. Now, take a look at the in the money numbers. Look at the price in the money. Remember, you take your premium number right here, you times this by 100, right? These are the prices. Now, this is going to cost you, move the decimal point twice, 1, 2. This is going to cost you $93. This one is going to cost you $191. We are going in the money and then deeper and deeper in the money. The deeper in the money you go, the higher the price of the option. But notice, this one's going to cost you $290. This one's going to cost you $93. This one up here is going to cost you $290. But look at the break evens. This one only needs to fall 0.2%. This one needs to fall 0.7%. So what you're doing is when you pay more, you're paying to have less risk. You're paying for less risk, but less risk, less reward. Let's go on and look at the out of the money call or puts. right? The out of the money puts, this means that the share price is 511. And all of these put contracts that you can buy, currently, they're out of the money. And they're going to have no worth at expiration if they stay out of the money. If they stay out of the money, they will have no worth. What do I mean by out of the money? That means that the share price is currently higher than any of these strikes. 511 is higher than 5. 511 is higher than 4. 511 is higher than 3. So now, since they are out of the money, notice how much cheaper they are than the in the money put options. This $6 in the money put option is $93. This out of the money put option is $11. Move the decimal point twice. This one that's way out of the money, family, it is $1 for this contract. But again, look at their break evens. To break even on this, you would need BNGO. If you bought this one, by October 15th, which is our expiration up here. By October 15th, if you held on that long, which you do not have to, you would need it to fall. For the $5 put, you need it to fall 4%, 4.31%, which would give you exactly the number of 4.89. Once it passed that on expiration, then you would still be up. But again, you can get out long before that. But notice, the further out of the money you go, or the deeper you go here, look how hard it would be for this to break even. You would need this thing to fall 41% in order for it to break even. But that's why it's cheap, because it's unlikely to happen. But in the event that you are right, you are going to make a lot of money here, a whole lot of money here. Now let's go to the next thing. We talked about the break evens, and notice that the break evens, the deeper in the money you go, the lower the break even is. The deeper in the money you go, the higher up you go, the lower the break even. Same thing is true in terms of the price. The deeper in the money you go, the higher the price. So you're paying to have less risk. Now, let's imagine that we decided to buy this $4 put option. Now let's look at everything that we see here. When you buy a $4 put, your break even by expiration is going to be $3.99. You need this thing to drop to $3.99 if you hold it all the way to expiration. That's going to give you a negative 22% change in the current stock price, which the stock price is $5.11. It would need to fall 22 or 21.92%. It's going to cost you $1 for this. Okay, let's say you picked it up. Now we're going to look at what's inside, what's under the hood. Notice BNGO $4 put for $10.15. Remember, with all put options, you want the price to fall down so you can make money on the way down. What you want to look at first is the open interest and the volume. The open interest is how many people picked this up before you got here. They already are in the play, right? 2,000. We like this. We like it to be over 1,000. You could go slightly under 1,000, but generally 1,000 plus is great. Now, the volume. This is how many of them were traded on the day, how many were bought and sold. So how many of this BNGO $4 put for $10.15 was traded today? 32 times it was traded. However, how many people are, or how many contracts were already picked up? How many people are already basically in the play? This is the open interest, 2,261. Now, notice, look at the bid. There's no one buying this. At this very moment, there's no one trying to buy this. So the bid, literally no one wants it at this moment. But notice the ask. There are 60 contracts of this one being sold for $2. 60 of them. Okay, now let's look at the Greeks. Let's look at the Greeks. BNGO, $4 put for $10.15. What I want you to see is this. The ask price is $2, right? You times this by 100 is $2. Let's say that you were to pay the ask price. You paid it. This is your premium. You would have a $2 premium. This is what you pay to get into play. Now let's look at the Greeks. It says this. The Greeks, delta, we would need this to drop $1 whole from 511 to 411. And then at that rate, guess what? You add delta to whatever the ask is right now at this point, and then it'll give you what the new price will be. So basically, you paid $2 for this, and then you add this 3 right on top of it. So if it dropped $1, family, you wouldn't make $1 on the play. You would have more than doubled your money because you would have paid $2, but now it would be worth $5. $5, family. This is the power of options. And imagine you buy many of these, and you would, instead of buying $2, you would turn, let's say you bought $200 worth, you would turn $200 into $500 if it was to drop by $1 alone. If it was to drop by $1 alone. This is the power of options again. So what you do, and again, is you say, what would happen if this option drops $1? If you're buying a put, you go look at Delta and it'll tell you what's happening. So if it drops $1, it's going to go up by this amount. So it's 0.03, but remember, you paid 0.02. So then you would make a lot of money in that way. Okay, now let's take a look at this. It's not all good. Remember, there's something called theta, time decay. So theta, they call it the theta gator because it's eating away at your gains. So now when you look at theta, we looked at delta. Theta, this is going to take away, remember, move the decimal point twice, 1, 2. So 72 cents every single day, but it'll ramp up as it gets closer. But you could think of it like every single day for now that it'll take away from what you paid. So you paid $2. Tomorrow, this thing is going to lose 72 cents already. But remember, if you want theta to be much lower, you want theta to be much significantly lower, you don't pick October 15th. You have to pick a further out date. And the further out the date, then you end up getting better thetas overall compared to what you paid for the option. So now, family, watch options class 1. Watch this one over. I might reshoot it. I'll let you know about that. But I'll watch it over myself and see if it needs some touches. But again, the quiz, I work on the quiz. I'll see you in the next one. Discord fam, I love y'all. And just know, I want you to watch this video over. And as you watch it a few times, it'll make sense and then more sense and then more sense. But again, hit the Discord